Well, let's drill into that theme. The expectation that America will cut interest rates again next month, December 10th, while Canada will stand pat. We're joined by Earl Davis, head of fixed income and money markets at BMO Global Asset Management. Earl, great to see you. That's your thesis, that we'll get a cut in the US and Canada will stay on hold?
That's exactly it. But the thing with the cut in the U.S., our expectation is that that's it for a little while. The U.S. will go on pause. So it'll be interesting to see how the market reaction is following the Fed meeting. So basically how we're looking at the market right now, we expect risk assets, which are, corporate bonds, equities, to do well until the Fed meeting. And depending on how hawkish a cut it is, we could see volatility following that. But overall, we're supportive of we believe it'll be 2026 will be a constructive year for growth.
For both countries, so GDP growth?
Yeah, definitely for both countries. So you're kind of seeing the surprise today for both countries, but more so in the U.S. We do believe Canada will lag, but still continue to grow, have positive growth. The main reason for the lag is the uncertainty around CUSMA and the negotiations with the U.S. Because as long as we have that uncertainty, you're not going to get the very large private market investments in Canada. Obviously, we saw with today's number, the public markets or government spending is buoying growth. We expect that to be supportive, but you won't get the private non-residential growth until you have an agreement.
It sounds like our economy is just running on the same old moonshine, government spending and investing in residential, not the stuff we really need. Businesses investing in plant and technology.
There's one other moonshine that you forgot there, and that's the U.S. economy, which is significant. Even though we still have the tariffs and whatnot, our economy is still impacted at least 60% by what the U.S. economy does. That's why you're seeing it reflected in in exports. And that's because the U.S. will continue to do well. They have a lot of deregulation that takes effect in 2026. In addition, they're discussing the deregulation of banks, which allows them to have more capital or loan growth, which is supportive. So there's a lot, and there's tax cuts that take into effect in 2026 in the U.S. So all these things buoy very well for the U.S., well for Canada, but less well because of the uncertainty.
Let's have a look at the Canadian 10-year bond yield. I know it's a ridiculously simplistic question for a guy like you. You're thinking yield curves off into the years ahead and mirrors within mirrors. But if you had a 5-year time horizon, would you be a buyer of Canadian 10 years at a yield of about 3.1% right now?
I'm going to answer it two parts. On a 5-year horizon, not necessarily, but we are buyers right now because on a 1-year horizon, we expect it to be within the range that you see. I think this is a great chart that you have on. We do expect the range for bonds to be exactly the same range as we had for 2025. So call it 360 to 275 on your page here. Mm-hmm. So we're mid-range, so we're all right buyers. But if we get up to the 365 level again, which we expect is a possibility in 2026, we will be very large buyers and go overweight bonds for that 5-year outlook. So timing is important. The yield is important because the yield you buy it at is the yield you will have until maturity. That is why at these levels, we prefer corporate bonds because you get your 320 that you see here on a 10-year bond, plus you'll get an additional, call it 125 to 150 basis points, depending on what type of bond you're buying for a corporate bond. So we are buyers of corporate bonds, not government bonds at this point in time.
I guess a couple of things could really hurt you if you hold 10-year bonds over the next few years. A ramp up in Canadian inflation. Is that a danger, do you think, Earl?
At this point, no. And the reason it's not a danger at this point, just think about it very simplistically. It's about supply and demand. So because of the uncertainty of the negotiations with the U.S., there's less demand here in Canada. You saw that in today's number again, less imports, less spending. So that means you have excess supply. When you get inflation is when you have excess demand. So we're a little ways until that. It's not a concern in Canada until we get an agreement with the U.S. Then you have to analyze the inflation outlook. But right now, no, inflation is not a concern.
And is there any risk of the bond vigilantes taking a run at Canada, given the threat to our economy from tariffs and also the low productivity growth?
I would say, and almost, I don't say definitely often, but I'd say definitely not.
Okay.
And here's the reasons why. When the bond vigilantes take a run at bond markets, they're not just looking at Canada, they're looking at global markets. And there's many other markets that are more at risk than Canada. I can name 3 right off the bat. 4, UK, we hear all the goings on with the budget. France, same thing, budget and political issues. Japan, getting more fiscal spending, and ultimately US. I think US will have an inflationary problem before Canada does. So when the bond vigilantes are looking, they're not going to go to Canada as the first place to start selling bonds, which makes us feel very comfortable buying bonds in Canada, specifically corporate bonds.
You have an interesting idea on corporate for a corporate bond buy here, Earl Davis. It's Interpipeline, and they're part of the Brookfield family. So you can buy these bonds, and they mature quite a decent time, 2032. You're getting a yield of about 4.3%. And so for somebody tying up money in the bond part of their portfolio, going right through for the next 7 years, you think this looks like a decent bet?
Yeah, and let me just explain the chart that you have on the screen, because it's not your typical yield chart. This is the spread chart. This is the spread that you're getting above government bonds. And I think that's important here. Actually, it might be the price chart, but nonetheless, it's very close to the spread you get above government bonds. It's about 125 basis points. So this is a price chart, which may be confusing for some. So you're getting you're getting roughly a 4.30 yield on a 7-year bond. Why we like it? We like the cash flow. When you buy bonds, it's different from equities. You're very concerned about getting your money back when that bond matures. And there's a few things we look at to get the money back. One is, most important one, cash flow of the company, and is it supportive and going in the right direction? This definitely is. The other one is you look at the sector, and people may say oil, look at the price and whatnot, but they have positive cash flow at these low oil prices, which makes us more constructive. We believe the range will hold, and if anything, we're at the bottom end of oil price range. So that's supportive, and that means you might get a price appreciation from upgrade in the spread. This is triple B, so investment grade. But we do like it very much, and we are constructive heading into 2026 of oil for 2 reasons. One is we believe we're at the bottom of the market. The other one is the spread you're getting. The valuations on the companies are still low compared to other sectors, and that makes it an attractive area to get additional yield and feel comfortable with owning those bonds. And
just we're tight for time, but the yield, I mean, it's not a great credit rating. It's triple B low, I believe, at DBRS. So it's only just one level above junk. But you think Brookfield, as a group, will do just about anything to stop that credit slipping into junk territory?
Yeah, well, I redefine that as high yield, because there's different types of high yield. And this would be actually an upper level credit or a high yield. It's the lower high yield, your triple Cs and like that we refer to as junk bonds. This could fall into a double B as opposed to a triple B, which would still be, we'd be supportive of. We're actually buying double B oil sector bonds as well, because the yield's attractive. So that's why we are very comfortable, but the trend is saying it should remain investment grade. If not, if our forecast comes through in regard to 2026 and oil, it could even be upgraded. So we do like it for that reasons, but that's why we're active managers. We have credit analysts that are looking at these companies, looking at these bonds every day, talking to management. And that's the important part in bonds and active management for corporate bonds is what do you select? And that's where you get your additional yield and feel comfortable with it.
Thanks very much. Thanks very much, Earl. Really appreciate it. Earl Davis of BMO Global Asset Management.